Most people buy stocks, cross their fingers or pray, and hope they go up over time. That's what 99% of people that invest in the stock market do, and over time they make about what the S&P 500 makes on average. Some years they win, some they lose, but overall they average about 7 to 10% per year over time. That's okay, and it's great for your 401k or retirement account. You want to save that money and just let it pile up over time. And you want it to grow conservatively without taking a lot of risk. But what if you want to create a side hustle and make some extra income on the side, or even trade stock options as a business in itself, separate from your 401k, savings, or retirement accounts? Instead of 7 to 10% per year, you want to shoot for 30 or 40% or more, just like a separate business on its own. In this video, we're discussing a key factor that is critical if you want to do just that. We discuss how to trade both sides of the market and not only make money when stocks move up, but when they move down as well.
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you just can't do buying stocks alone. Please hit the like and subscribe buttons below. I appreciate it, and it helps get the video out to more people. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. How do you make money in both directions trading stock options? The simple answer is you sell options on both sides of the market. If you don't know why we sell versus buy options, make sure you check out that free workshop. It talks about how time decay works in your favor when you sell options and how it works against you when you buy them. Now, when we sell options on both sides of the market, we look to set up our trades at 45 days to expiration. This is a sweet spot as it allows us to collect the most amount of premium, taking advantage of time decay while still getting a good amount of turns or premiums collected throughout the year. Why do we sell options on both sides of the market? There's a couple of reasons. First, it's because in the short term, there's a 50% chance that stock prices move up and a 50% chance that they move down. Even CEOs of companies don't know if their company stock will move up or down in the short term. This is market efficiency, and it's driven by the buyers and sellers of stocks. For this reason, stock prices must move up and down both ways. Supply and demand moves the stock price. The second reason to sell both sides of the market is simply to make more money. Why just make money only when stock prices move up? Since they move down half the time, let's make money when that happens as well. So we know how to sell cash secured puts and put verticals that benefit when the market goes up. We do this in the stocks that we like best and think will move up in the near and long term. Maybe a stock like Tesla or Devon Energy is at lows and we think that they are on sale. We know that they're great companies and will move up and move forward at some point sooner or later. So we place those trades at 45 days to expiration and roll at 15 to 21 days to expiration, collecting more and more premiums month after month as they move up in price. Now, let's take a look at how we can place a trade that benefits when the market moves down. Since we've picked out stocks that we think will go up faster than the market as a whole, when trading the other side, I often utilize ETFs to cover the entire market as a whole. I like to use ETFs like QQQ or SPY and sell call verticals. Here is an example of how to sell a call vertical in SPY, which is the S&P 500 index. We go to the Tasty Trade Options trading platform. It's the best broker and platform for trading stock options. I'll put a link below. We punch in SPY in the upper left and look at the option chain. We're on the trade tab and in table mode. We look at the April 21st option chain since it's closest to 45 days to expiration. We click on it and open the option chain. The SPY ETF is currently trading at $404, so we click on the bid on the 415 to sell the 415 call and the ask on the 425 strike call option. So this is a $10 wide vertical. It's 425 minus the 415 strikes. So it's $10 wide. And I like to collect about a third the width of the strikes. So in this case, we're collecting $3.03, or that's really $303 since there's 100 shares in each contract. Our max loss is $697, which is the $10 width of the spread minus the $303 in premium we collected. Now let's switch to the curve mode by clicking on curve. You can see that if the stock moves down or just stays below the 415 strike price at expiration, we keep the entire $303 that we collect when we place the trade. With the stock at $404, it can still move up $11 and we keep the entire premium. This trade has a 68% pop or probability of profit, so we hit review and send to place the trade. Now that we have this trade on, we have some negative delta. In other words, we can now profit when the market goes down. There are multiple advantages to having this trade on. On a big down day, we can buy back the trade and profit. We then rinse and repeat, and on a big up day, we put the trade on again. We also can offset losses on the down days that happen in our long stock plays, so it lessens risk. And lastly, if the stock moves up and we start to lose money on the trade, we know we're making money on our long stock trades. If the market moves up against us, it's okay. Being a vertical, we have bought the protective long call, so we know our max loss. However, we are almost never going to take max loss. At 15 to 21 days to expiration, we will look to roll out to the following month and collect additional premium. Even though the market moved up against us, we know that won't always be the case. We always have to keep this in mind. When we don't profit right away, we just roll out to the next monthly cycle. We collect more premium and then wait for it to move down and then profit when it does. We know that it will. So we always want to have some trades in both directions and not just one direction, betting that the market will go up. We may have more bullish trades on when the markets are at lows and more bearish trades when the markets are at highs. So the great thing about trading both sides is that we increase our profits. We make money on both sides whether the market moves up or down. This reduces risk since you cannot lose on both sides. You can only lose on one side, so you'll always win on one side. Risks are reduced since the winning side will offset the losing side. When we do lose on one side, we know that it's only temporary. We roll to the next month, collect more premium, and just wait for the market to drop. The good news is that sometimes we win on both sides right away when the price stays within the trading range. And we know that long term, we're going to win on both sides.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching and see you in the next one.